Welcome to Invest Giant. Learn, invest, build your net worth. Today we're diving into the world of ETFs, specifically 5 ETFs that could be the cornerstone of your portfolio. When it comes to long-term investing, choosing the right ETFs is crucial. Over the next few minutes, we'll break down each ETF, exploring their strengths, risks, and why they might be a good fit for your investment strategy. Stay tuned. First up, we have the Vanguard Total Stock Market ETF, ticker symbol VTI. This ETF is like the ultimate all-in-one package for U.S. stocks. It gives you exposure to large, mid-cap, and small companies, effectively covering the entire U.S. stock market. This broad diversification helps spread your risk. VTI also boasts an incredibly low expense ratio, which means you get to keep more of your hard-earned money. Think of it this way: if you invested $10,000 today and earned 7% annually after 30 years, you'd have over $76,000. But with high fees eating into your returns, that number could be significantly lower. That's why opting for low-cost ETFs like VTI is crucial for maximizing your long-term gains. Imagine a hands-off approach to investing, where you don't have to constantly pick and choose individual stocks or worry about timing the market. That's the beauty of VTI. It's like setting your investments on autopilot and letting the entire U.S. stock market work its magic for you over the long haul. As the U.S. economy grows, so too should your investment in VTI. But remember, no investment comes without risk. The stock market has its ups and downs, and VTI will reflect those fluctuations. However, by staying invested for the long term, you're more likely to ride out any short-term volatility and benefit from the overall upward trajectory of the market. If you're looking for a single ETF to anchor your portfolio and provide broad exposure to the U.S. stock market, VTI is a fantastic option to consider. Its low cost, broad diversification, and long-term growth potential make it a compelling choice for investors of all ages and risk tolerances. Just remember to do your own research and make sure it aligns with your overall investment goals. Next up, let's talk about the SPDR S&P 500 ETF Trust, better known by its ticker symbol SPY. This ETF tracks the S&P 500, an index of the 500 largest publicly traded companies in the United States. We're talking about heavy hitters like Apple, Microsoft, Amazon. These are the companies that drive the U.S. economy, and by investing in SPY, you're getting a piece of that action. One of the biggest advantages of SPY is its historical performance. The S&P 500 has consistently delivered solid returns over the long term, making SPY a reliable choice for investors seeking growth. Another great thing about SPY is its liquidity. Because it's such a popular ETF, it's incredibly easy to buy and sell shares of SPY without significantly impacting the price. Now you might be thinking, SPY sounds pretty similar to VTI. What's the difference? Well, SPY focuses on large-cap companies, while VTI includes mid-cap and small-cap stocks as well. This means that SPY might be slightly less volatile than VTI, but it also might miss out on some of the growth potential of smaller companies. SPY has a slightly higher expense ratio than VTI, although it's still very low compared to many other investment options out there. So, which one should you choose? It really depends on your individual investment goals and risk tolerance. If you're looking for a slightly less volatile option with a focus on large-cap companies, SPY might be the way to go. But if you want broader exposure to the entire U.S. stock market and don't mind a little extra volatility, VTI might be a better fit. Ultimately, both SPY and VTI are excellent ETFs that can form the foundation of a well-diversified portfolio. The key is to understand their differences and choose the one that aligns best with your investment strategy. Now let's shift gears and talk about the iShares MSCI Emerging Markets ETF, ticker symbol EEM. This ETF is all about tapping into the exciting world of emerging markets where growth potential is often through the roof. We're talking about countries like China, India, Brazil, and others that are experiencing rapid economic development. Emerging markets can be more volatile than developed markets. However, for investors willing to stomach a little extra risk, emerging markets offer the potential for significant rewards. EEM gives you exposure to a broad basket of emerging market stocks, allowing you to participate in their growth without having to pick and choose individual companies. Think of EEM as a way to diversify your portfolio beyond the U.S. stock market and potentially boost your returns. As these emerging economies continue to grow, their stock markets are likely to follow suit, which could translate into substantial gains for EM investors. By investing in different asset classes and geographic regions, you're spreading your risk and reducing your portfolio's overall volatility. Remember the old adage, don't put all your eggs in one basket? Well, EM is like adding another basket to your portfolio, one that's filled with the growth potential of emerging markets. The idea is to allocate a portion of your portfolio to emerging markets, depending on your risk tolerance and investment goals. For some investors, that might be 5%. For others, it might be 10% or even more. The key is to find the right balance for your individual circumstances. Just remember, emerging markets can be volatile, so it's important to be prepared for some ups and downs along the way. But if you're patient and have a long-term investment horizon, EM could be a valuable addition to your portfolio. Let's talk about the Invesco QQQ Trust, ticker symbol QQQ, an ETF that's all about riding the tech wave. QQQ tracks the NASDAQ 100 index, which is comprised of 100 of the largest non-financial companies listed on the NASDAQ stock market. Now, if you're familiar with the NASDAQ, you know it's home to some of the biggest tech giants on the planet, companies like Apple, Microsoft, Amazon, Google, Facebook. These are the companies that are shaping the future, from smartphones and social media to artificial intelligence and cloud computing. Investing in QQQ is like investing in the future of technology. It's a bet that these tech giants will continue to innovate, grow, and dominate their respective industries. And let's be honest, it's hard to argue against the long-term potential of technology. Just look at how much our lives have changed in the past decade alone. Now, I know what you're thinking. Isn't QQQ too risky? What if the tech bubble bursts? Well, it's true that the tech sector can be volatile, and there have been periods of rapid growth followed by sharp corrections. However, it's important to remember that QQQ is not a bubble. It's an ETF that tracks a diversified basket of established tech companies with proven track records. Of course, past performance is not a guarantee of future results, but the long-term growth potential of the tech sector remains undeniable. And as technology continues to advance and permeate every aspect of our lives, QQQ is well positioned to benefit. Just remember, as with any investment, it's important to do your own research and make sure QQQ aligns with your overall investment goals and risk tolerance. Make informed decisions based on your own financial situation and long-term objectives. Finally, let's talk about a different kind of ETF, the Schwab U.S. Dividend Equity ETF, ticker symbol SCHD. This ETF is all about dividends, those sweet cash payments that companies make to their shareholders. If you're looking for a way to generate steady income from your investments, SCHD might just be your new best friend. SCHD tracks the Dow Jones U.S. Dividend 100 Index, which is comprised of 100 U.S. companies that have a history of paying consistent and growing dividends. We're talking about blue-chip companies, those stalwarts of the market that have stood the test of time and continue to reward their shareholders with a share of their profits. Investing in SCHD is like owning a piece of these dividend-paying machines. As these companies generate profits, they distribute a portion of those profits to shareholders in the form of dividends. And the best part? You can choose to receive those dividends as cash payments or reinvest them back into the ETF to buy more shares and compound your returns over time. Now, you might be thinking dividends are great, but what about growth? Don't dividend-paying companies sacrifice growth for income? It's true that some companies prioritize dividends over growth, but that's not always the case. Many companies in the Dow Jones U.S. Dividend 100 Index have a long history of both paying dividends and growing their earnings over time. This means you can potentially enjoy the best of both worlds, a steady stream of income from dividends, and the potential for long-term capital appreciation as the value of your shares increases. Now, I'm not saying that SCHD is a get-rich-quick scheme. It's not. It's an ETF designed for investors who prioritize income and stability. If you're looking for high-flying growth, you might want to look elsewhere. But if you're retired, approaching retirement, or simply want to generate a consistent stream of income from your investments, SCHD is definitely worth considering. Just remember, as with any investment, it's important to do your own research and make sure SCHD aligns with your overall investment goals and risk tolerance. Don't just invest in something because it sounds good on paper. Make informed decisions based on your own financial situation and long-term objectives. There you have it, 5 ETFs that could form the bedrock of your investment portfolio for years to come. From the broad market coverage of VTI and SPY to the growth potential of EEM and QQQ, and the steady income stream of SCHD, there's an ETF out there for everyone. Remember, investing is a marathon, not a sprint. Choose ETFs that align with your financial goals, risk tolerance, and time horizon. Most importantly, start investing early and stay invested for the long haul. Thanks for watching. Don't forget to like, subscribe, and hit that notification bell for more videos on building wealth and achieving financial freedom. Happy investing!